Last one. Nationwide is. You guys know insurance karaoke, right? Now here's the thing. How many, because you knew the insurance song, said, hey honey, we need to call Nationwide and set up our retirement account. That doesn't happen, does it? How do financial products and services actually get distributed to the marketplace? Because an agent sits down with somebody to sell it to them. And how do we teach you how to sell to people? You educate them. Okay, Mr. Client, you have a 401k at a former employer. You got two options. Number one, leave it to chance. It's out of what they can contribute into a Roth IRA. So the more money you make, the less you can contribute into a Roth IRA. And what's the maximum you can put inside a Roth IRA? $6,000 a year. So if your client wants to put $1,000 a month into a deposit, just like we did with this guy, it won't work. Why? Because he's putting in too much money that would be over and above what you can put inside a Roth IRA. And in addition to that, the guy makes some money, right? So his income phases him out of contributing to a Roth IRA because the guy makes a lot of money. Okay, so and then money, according to then 8702, means money that accumulates inside his policy can be withdrawn without paying a dime in tax. So you finally got this $105,000 inside his policy. Now who's in control of that money? You are. Before, who's in control of the money? The banks. Right? Just so you know, there's one or two ways you're going to own property. Either you completely mortgage all the way to the hilt, or you completely pay it off. Anywhere in between, it's kind of risky. Why? Your money somewhere. So if somebody gives you an opportunity, how do you process systematically of whether to say yes or no? And this is something you need to know and something you need to teach your clients. Every opportunity should have at least 4 elements. This is your system. Why do you use a system? Because the more systematic you are in making decisions, the less emotional you are. And how many guys know that usually money, you're very emotional about it? Okay, so what's the criteria? You guys know the laser test? So basically, essentially, to the title company, you're buying it with what? Cash. So Patrick makes an offer. 20 million, we can close in 30 days. Buyer's like, damn, you're not financing it? No, none of your business, how I'm buying it, here's 20 million bucks. Buyer says, shit, I'll take the offer. So in 30 days, he closes on a house. Now, what does he do after that? So where do you use the $20 million from? The line of credit. So at the end of closing, 6 months later, guess what Patrick does to get his $20 million back to pay off his line of credit? He then refinances it. In their equity, in their real estate, in their homes. They're living in their money. So when you're sitting down with them doing a proper FLS, that's why you should ask them what their mortgage is like. So when you ask them, what's the mortgage balance on your property? What's the interest rate? What's the payment that you have on the mortgage? Tax, PITI. What's PITI mean? Principal, interest, taxes, and insurance. You got it, my man. PITI. See, you sound a little bit more educated coming out of the class today. Okay. Doing this 401k rollover is already very beneficial for the client. How many guys feel that way, right? Why is it beneficial to a client? Number one, there's minimum guarantees of protection for the downside. And number two, guaranteed no loss, but potential for upside gain. And then if you use the income rider, you have guaranteed income rider through an annuity. But this is the oldest form of life insurance. Just so you guys know, annuity. Annuity has been around since before Jesus was ever born. That's how old this has been. It stands for? Safety. Is money inside this particular opportunity safe? Okay? Well, let's say somebody puts in Bitcoin. Is it safe? No. Okay. But it does have a R stands for? Rate of return potential. Usually people focus only on this. Last but not least, what does T stand for? Tax advantage. I want to make sure that whatever money I have growing, I can keep majority of it due to keeping Uncle Sam and cousin Texas or cousin Illinois or cousin California out of my pocket. Okay? Out of my pocket. So these are the characteristics. So you guys get it? To pay off the line of credit. And the mortgage interest now he's paying on his personal credit, whereas if there's a personal credit or his business credit, either way, he refinances the cash. Why? Because you want control of what? Your capital. What are the 4 characteristics that we talk about that your clients need to have? So in other words, somebody said, hey, put your money here, put your money here, put your money here. And you say, oh, okay, why? Well, this dang gone crypto is going at 500%. Okay, should that be your only criteria of where and why you should put your Tefra? Oh, sure, this is Tefra. Tefra. This one is Tamra, 1980. 1984 is Defra. Right, Jesse? You got that. So Tefra, yeah, Tefra here, 1982, Tamra, 1988. So this forced you to not throw all this cash in all at one time. This tax law said you got to spill in this money over a 4 or 5 year period. And who created it? You can thank a Roman Empire for this. The Roman Empire, when you retired from the Roman Empire, they paid you something called an annuitatum. Okay? So you retired from the Roman Empire, they paid you an annuitatum, which today is called a annuity. Right? So before they created this life insurance death benefit, they had a guaranteed income for the rest of your life. And that's what you're still providing to this day. Okay. Now, what's the other play you can have here? Somebody's still working there, and they are not being, because you're exposing your equity to either market conditions or your inability to pay it based on change in income. Because think about this: you lose your job. You lose your job. You got all this trapped equity. You got $150,000 of trapped equity inside your house. You lose your job. You run out of unemployment checks. You drain down your 401k plan, but you got $150,000 stuck in your house. How do you access it? You can't, because will the bank allow you to access money inside your own property? So the $350,000 and the $500,000, they have this equity trapped up inside the house, right? Okay, now, the question for you is, how much of that equity is putting money in your pocket? Right, so for example, the better question is, if you had $150,000 of an investment, do you want to put money in your pocket every month? Of course. I got 150 grand out there, I want to put money in my pocket, because that's the way rich people make money. You think my investments in other businesses put money in my pocket every month? Of course, because that's why we invest in laser test. L stands for liquid. This is what I'm talking about, laser test. Okay, LSRT, laser test. Okay, any investment opportunity should have, in our opinion, it can be different for many different people, but in general, what works for us to keep you safe and secure has these 4 qualities. Just remember laser test, LSRT. L stands for liquidity. Right, it's liquid. It's liquid. You got liquidity. Okay? So in other words, you put your money in, and relatively soon you can get your money back out. S stacked will be if you really apply yourself in business. So just don't think short term, think long term. Now, with that being said, on a $105,000 life insurance policy of cash coming in, so 105 divided by 5 is what? Divide this by 5. What? A little over 21,000? Now you're structuring your policy, 21,000 a year and 21,000 a year, right? Or a 5-year period, if you guys can read my writing. So 21,000 a year into the policy. 21 companies, they pay you a dividend, you're sharing the profits of the company. So the reason a lot of people aren't enjoying it here because it's trapped up inside a 401k account that you can't touch until you're 59 and a half years old. But if you had $150,000 investment outside of a 401k, don't you want that money put in your pocket today? So here's the move. I'll finish up with this. I promise. Promise. So now, in this move, here's the play. You cash out refinance. You refinance a house, not at 315, but you refinance a house with 80%. You already have like 3 or 4 plays just with these 2 right here? Yeah. With your insurance license. That's how powerful your life insurance license is. Okay, 3rd play. I'll wrap up with this. Strategic equity finance from trapped equity. Now, his property value inside, kind of touched on this last week. Has property value increased or decreased in Dallas? It's increased. Okay, so in this example, I put something about a $350,000 house. Would it be safe to say that over the last 5, 6, 7 years, that $350,000 house probably appreciated to $500,000? Okay. Yeah. Huh? All right, cool. So these things. Now, back to my example here. They're setting an initial $500 a month extra. So are they decreasing or increasing the equity inside the property by adding an extra payment into additionally paying off their mortgage? They're seeking to potentially increase it. But who's got the other hand in that factor of a property appreciating? So one play, they can pay down the mortgage to potentially increase the equity, right? And then what else? So in DeSoto, apparently. Okay. All right, so now over time, over the last 5, 6, 7 years, the property value grew from $350,000 in addition to the additional mortgage payments the client's been sending to the mortgage company. The property grew to $500,000. So how much equity is now inside the property? $150, right? So 500 minus 350 is? It's 250. It's 250, right? So excuse me, 150. Where's my math, right? So essentially, $500, right? But would you pay $500 to have access to 105? And then is mortgage interest, according to the IRS today, tax deductible? Yes, because you receive a 1098 at the end of the year for mortgage introduction to filing your tax forms. So interest that you just refinanced now, even though it's a larger amount, now it's tax deductible on your personal income taxes. But without income, no. So who is in control of the equity inside your house? The banks are. Now, what are you putting more in favor by doing a strategic cash out refinance? Who are you putting more in favor? You as a homeowner. And the way you structure this, because this is life insurance, right? What do you want to make sure? You have at least a $400,000, $450,000 death benefit. So in case something happens to the client, the mortgage balance is completely paid off. Anyway, that's the move. That's the play. Your former employer. And do you think your former employer has a vested interest to make sure your 401k accumulation value is best optimized for your success? Because it's a former employer, right? Or you can roll it over to a IRA and you can gain control of it. Which would you prefer? Okay, it's great. Let's fill out the paperwork. Fill out the paperwork, right? 30 minutes of paperwork, 45 minutes of paperwork. Now you got a $100,000 rollover. Now, for those of you that have never done this, let me share with you. But by the way, before you get there, how many feel that the payoff of their house because they want to be debt free? Now, two types of debt, right? Good debt, bad debt. Yes. What's good debt? Real estate. That's good debt. Okay, that's about it. If you're not an entrepreneur. Now, if you're an entrepreneur, what's another form of good debt? Business debt. Why? Bless you. Why is business debt? Why is business debt good debt? Because interest that you owe and you're paying on a monthly basis for paying off business interest is what? Tax deductible. Also has to happen in order for the property to increase. The market has to respond. So in other words, your neighbor has to sell it for a higher value than what they bought for. Your neighbor has to sell it for the same, what do you call that, real estate, same comp, that's correct, the same comp. The same comparable property has to sell at a higher value in order for the equity in your property to also increase. Okay, so if you got those factors going on, which for the most part, Dallas has got going on right now, which means that a large part of your clientele not only has net worth and wealth inside their retirement accounts, but they also have it trapped where? You're the bank. You negotiate the terms now. But legally and ethically, you've made your play. Why? Because you made money and you stacked cash. And you became the bank. For some of you saving this money inside this, and I'm excited for you in the next 1 year, 2 years, but for some of you, I've been thinking about 10, 15, 20 years from now. Think about how old you'll be in 10, 15, 20 years. Some of you guys are not even my age yet. You'll be much further ahead financially before you even hit 48 years old. Think about how old you're going to be in the next 10, 15 years. How much more financially present a certified check for $50,000. But now I have a promissory note with you that you pay me 12% interest or 50% interest or 20% interest in the next 90 days or I secure your property. Now your property's mine. That's the way a hard money lender works if you don't pay money back. Okay? Now let's say they don't pay you in 90 days. Well, guess what you have? What you have now is another asset. You have another house. And then you negotiate with them. Listen, you promised to pay me in 90 days. You want to complete the project? I'll cut some of the interest off. Again, either they're not being matched on their 401k or a portion is being matched. So what's the play? The play is to redirect what they're not being matched on into a retirement supplement strategy funded by a IUL, an Index Universal Life Policy, or a potential Roth IRA. These are your two options, okay? By the way, can you do both? Yes, you can do both. You can do Roth IRAs and Index Universal Life. What's the downside to a Roth IRA? Now, if they make a certain amount of money, they will be phased out. The difference now is you released $105,000. And then you can put this aside Index Universal Life, or you can say, hey, let me set aside $20,000, $30,000, okay, as down payment to buy more real estate. Why? Because you know when the crisis comes, those with cash will be the bankers. It won't be the local banks, the credit unions. It's going to be you. You'll be the local bank. Every time this has happened to me, everybody, 01.com bubble, I had cash, I accelerated my business. 0809, Great Recession, I had cash, I accelerated my business. I became the pawn shop. Right? I became the pawn shop. I became the hard money lender. Bobby? You're the hard money lender now. You know what hard money, what do you mean by that term? How many guys know what he means by hard money lender? Okay, the real estate investors know what that is. In other words, for lack of a better term, you're the loan shark. Okay? So somebody said, hey man, I need $50,000 to complete my real estate project. I was like, I got the cash. You want to close on property? Great. I'll see you at the title company. We met Tom Brady. Is David Gomez still here? Or he's out there? He's out there, right? So, for example, we met Tom Brady's business manager, right? For TB12 last 15 years. So one of the questions I asked him is, how does Tom Brady pick up Brandon what to endorse and get a paycheck from? So he tells me he's got to meet 3 criteria. See? So even rich people have a criteria of what to say yes to and what to say no to. Okay? And maybe down the recap, for those you qualified for the recap, you'll be the first to find out. Okay? Excuse me, what's the pity on your mortgage payment? What does it stand for? I don't remember, but I'm just asking a question. PITI, what does it stand for again? Principal and interest, taxes, and insurance. Okay? And some of you fancy ones live in a fancy neighborhood, what's also the HOA fees, right? Homeowners Association fees, right? Depending on your neighborhood, because your homes all got to kind of look like the same way, okay? Right? So 105K, now you've released from being trapped. Because this 105,000 inside the house, was it earning any interest? No. Now that you released it and you put inside a potential index universal life policy, will it have some form of rate of return? Yes. So now you've unlocked the interest on this 105, which previously was not. But here's the flip side. Instead of you sending an additional payment to the mortgage company, you refinance the house because your mortgage payment went from $1,691 to $2,147. The mortgage rates was approximately 4%. So let's say they bought the house 5 years ago at a 4% interest rate, and the mortgage balance was $315 at that time when they first started. Now this person wanted to add, because they were told by Dave Ramsey, they were told by the financial advisor, they were told by the pastor, hey, pay off the house, pay off the house, pay off the house, pay off the house. Okay, is a wise strategy? Cool. They did it? Fine. So they're sending another $500 a month extra into the mortgage. So on top of their $1,691, they're adding another $500 to do what? To accelerate the marketing advertising budget at an insurance company. Do you know why? Because they figured commercials don't really work. Insurance karaoke doesn't work. You know what insurance karaoke is? Some of you guys don't know what insurance karaoke is. Okay, let's start. Okay, here we go. I start, you finish. You guys ready? We are farmers. Very good. Okay, here's another one. Like a good neighbor. You guys are good at this, right? $1,000 into the policy. $20,000 into the policy. Coming from where? From money that was normally inside the home. But you're putting 21, so how come, Matt, we can't put $105,000 inside the policy? Back to this one. Because now we're going to create a modified endowment contract. Because why? Money that grows inside a policy that's a modified endowment contract becomes taxable. So the rule here is another rule in 1988 called TAMRA. Okay? First one is TEF, that's a safe number here. I don't know, you guys educated me. Okay, so let's say this $350,000 house grew to $500,000. In a typical mortgage, non-FHA, what's the normal down payment for a lot of people to buy a house? Usually 10 to 20%, right? So I'm going to be very conservative. Let's say they put 10% down. Okay? So what's 10% of $350,000? It's $35,000. So what did they really mortgage on a house? $315, right? So $315 is what they got the mortgage on. So based on, I Googled this 5 years ago. The thing, by the way, it's all written up, so I'm not sharing with you some insider information that isn't publicly known. Did Patrick have enough cash to pay for the house? Cash. But instead of using his cash at his Goldman Sachs account, Goldman Sachs said, hey, here's a line of. So in order for you to close, instead of you waiting on the mortgage 60, 90 days, why don't you make a strong offer? And part of strong offer is not only the amount, but also how fast you can close. So guess what happens when you have a lot of money inside a brokerage account and they give you a line of credit? You go to the line of credit, you just write a check on a line of credit. What happens if somebody's got 6% match, but they're putting in 10% inside a 401k? Haven't taken advantage of it. So if they're putting 10% and they're getting matched 6%, what do you want to redirect? So the 4% that's not being matched, right? You redirect that into not a rollover, but inside an IUL or a Roth IRA. Roth IRA, which is funded by a index annuity. So these are some options you have. By the way, it's 80% of 500,000. It's 420, right? So the 420, you refinance a house at 420 because it's 80% loan to value, right? So again, what's 80%? Do the math. What's 80% of 500,000? It's 420. Okay. So $420,000. Now, what's the difference between 420? The difference between 420 and 315. 420 and 315 is. Is it 105? Okay. Okay. So for example, Apple and Amazon, they got 86 and 90 billion dollars of cash just sitting on the side. When they acquire a company, do they pay cash for the company or they use a loan to buy the company? Why do they use a loan? Why don't they just pay cash for it? Huh, it's interesting, huh? Our CEO, founder, Patrick David, his $25 million house that he bought in Fort Lauderdale, did he buy cash for it or did he use a loan for it? What type of loan? Here's anybody that you're talking to this weekend. Hey, put your money here, put your money to Cardano, put your money towards real estate, put your money to buying raw land. Great, because they have these 4 criterias. Hey, cuzzo, did you pass the 3 criteria, or are you just emotional about it? So now you look a little bit more seasoned and educated when it comes to pragmatic investment opportunities. That's the way you would want to. Do you think, for example?